let me send greetings and best wishes to all guests and audiences here. Welcome to our program, Financial Literacy Today. I am pleased to invite two guests here. Welcome Ms. Hoàng Thanh Trúc and Ms. Lê Phạm. Nice to meet you. Could you introduce yourself and say hello to the audiences?
Hi everyone. First of all, it's a pleasure being here today. Now I would like to introduce myself. My full name is Phạm Khánh Ly. You can call me Ly Phạm. I graduated from the University of Economics and Business with a master's degree in finance and banking. I have 2 years experience of working as a chairman of the State Security Commission, and the second guest sitting by my side is my assistant manager, Ms. Hoàng Thanh Trúc. Introduce yourself.
Hello everyone. Today is a good day and I'm very glad to come here with Miss Lee. My full name is Hoàng Thanh Trúc and you can call me Trúc. I graduated from Academy of Finance with a doctorate degree in finance and banking. And now I'm assistant manager of the State Security Commission. I'm willing to share the knowledge about finance with you in program broadcasting today.
It's very kind of you to join our program, and the topic today is bond and stock. Let us answer all your questions about bonds and the similarities and differences between bond and stock. Ms. Lee, I would like to ask you, what is a bond?
From my perspective, a bond is a long-term debt instrument in which a borrower agrees to make payments of principal and interest on specific debts to the holders of the bond. It is issued by both government, corporations, or other organizations to raise capital.
Thanks for your opinion. Now, can you explain other related concepts to better understand bonds?
There is a lot of risk associated with bonds, so we will define some of the most important terms. The first one is coupon yield, the stated interest payment made on a bond. The second one is maturity, is the specified date on which the principal amount of a bond is paid. And the next one is coupon rate, the annual coupon divided by the face value of a bond. The coupon rate of a bond is the stated rate of interest that the bond will pay. The coupon rate doesn't normally change during the life of the bond. Instead, the price of the bond changes as the coupon rate becomes more or less attractive relative to the other interest rate. The coupon rate determines the dollar amount of the annual interest payment. Annual PMT equal coupon rate multiply face value. And the last one is face value, the principal amount of the bond that is prepaid at the end of the term, also called par value.
Oh, it includes yield, or we can call yield to maturity with short. For YTM is the rate required in the market on a bond, doesn't it?
I think I accept with you. Sorry for forgetting to mention it.
Excuse me, it's hard for me to understand. Give me an example, please.
No problem. For example, the government of Canada issued a bonds with a face value of $1,000 in July 1993, which matured in July 2023. The stated annual interest rate is 12%. Here, the face value is $1,000. Annual coupon is 12% multiply $1,000 equal to $120. Time to mature is 30 years, and maturity date is July 1st, 2023.
I got it. Thanks for providing useful information about bonds. So, on that basis, how about the characteristic of bonds?
The most important common characteristic of bonds refer to the bond issuer, fixed income, credit rating, bond price, and bond yield. The first is bond issuer. Quality of issuer decides safety of bond. The second is fixed income. Bonds pay a fixed rate of interest to the bondholder. This means that the bondholder will receive a predetermined payment amount over the lifetime of the bond. The next is credit rating. Certain risks can be checked using a rating agency. The higher the credit rating, the lower the risk, and the lower the interest rate paid on the bond. The fourth is bond price. The current market price of a bond is expressed as a percentage of face value. Bonds are tradable in the secondary market, and the price at which bonds can be bought and sold are recorded in percentage terms. For example, a bond could have a price of 102%. Therefore, if a bond trades at a price of 102% and the inverter buys a bond of $100 million face value, the current market price of the bond is $102 million. The last one is bond yield. This refers to the returns an investor will derive by investing in a bond. It is calculated by dividing the annual coupon on a bond by its current market price. Bond yield equal annual coupon payment on a bond price. The annual coupon payment is computed by multiplying the face values of a bond with its coupon rate.
Is there a relationship between bond price and bond yield?
Yes, bond price and bond yield have an inverse relationship. When the price of a bond goes up down, the yield goes down up.
Thanks. From what I understand, the classification of bonds will be according to different criteria, such as issuer, yield, level, payment security, form, and nature of bonds. So what are those?
Bonds can be classified according to three main criteria: maturity, currency, and issuer. The first one is maturity. Bonds have a fixed term, known as a fixed maturity bonds, and bonds without fixed term, known as perpetual bonds. The second one is currency. Bonds can be issued in various currencies and can be classified according to the currency in which they are denominated. Example includes USD denominated bonds, Euro denominated bonds. And the last one is issuer. Bonds can be issued by various entities, including governments, private corporations, non-profit organizations. Bonds issued by governments are known as government bonds, while bonds issued by private corporations are known as corporate bonds. These criteria can be used to classify bonds and make investment decisions that are appropriate for the investment objective and strategy of investors.
Thanks for your answer. Next, in order to understand more about the topic bond stock, we would like to ask, what is a stock?
A stock represents a share in the ownership of a company, including a claim on the company earnings and assets. Equity is another term for stock. Holding a particular company shares makes you a shareholder and are entitled to a portion of the company profits, as well as a right to vote on certain matters. related to the company's operations.
There is a question that I think everyone here wants to listen. Can you compare stock and bonds to be able to make the best decision to invest in? Please invite Miss Lee.
Yes, to talk about the similarities between stock and bond, I see the biggest similarity between stock and bonds is that both of them are financial securities sold to investors to raise money. With stocks, the company sell a part of its sales in exchange for cash. With bond, the entity gets a loan from the investor and pay it back with interest. In terms of this difference, from an investor point of view, stock and bond are completely different. In my opinion, the biggest and most obvious difference is that stocks are risky and volatile but can provide high long-term return. Bonds tend to be low risk and low reward, with some exceptions.
Can you explain more about this point?
For example, these days US Treasuries only have very low yield of 0 to 1.3% in comparison. The US stock market has returned close to 10% per year historically, although there is no guarantee that this will continue indefinitely. Stock prices tend to be highly volatile, and stock investors often lose or gain a significant percentage of their net worth within a matter of days or even hours. Many investors are unable to tolerate the volatility and end up buying or selling at the wrong time. But those who buy and hold stock for many decades usually end up making money. Unlike stock, the price of investment-grade bonds tend to be very stable. The price mostly moves based on inflation and interest rates.
However, as far as I am concerned, the price of riskier junk bonds can swing wildly based on the perceived risk of borrower defaulting on its debts. So, it is definitely not true that bonds prices are always stable. So, even though bonds are generally safer than stocks, there are exceptions to this. Some stocks can be considered safe, while some bonds can be risky.
I think it's a rare circumstance. Secondly, see another difference is stock represent ownership in a company, while bonds represent debt. For example, some recent high-profile IPOs, as abbreviated in English, initial public offering, include Spotify, SBOT, and Uber, UBER. When these companies did their IPOs, they received billions of dollars from the thousands of investors who bought the company's share in an IPO. A company is basically selling a part of its share for cash. After the IPO, investor and trader can then buy and sell their company share on the stock market. In the US, the two primary stock exchanges are the New York Stock Exchange (NYSE) and Nasdaq. Both of them are accessible through various online brokerage companies. Bonds are financial instruments which state that some entity owns your money along with regular interest payment. Bonds are often called credit, debt, or fixed income security. When you buy a newly issued bond, you are effectively lending money to an entity, such as a company, corporate bond, or the government treasury bond. If you buy a bond from another investor, then you are taking over the ownership of the loan that someone else provides. A company that issue or sell a bond to investor is effectively getting a loan, just like an individual might get a loan from a bank to buy a house.
Yes, thanks for the useful information you mentioned. Chup, how do you feel about the difference between them?
Yes, I'm exactly of the same opinion as Miss Lee. Moreover, I would like to provide more information about the difference between stocks provide the owner with voting rights in a company, while bondholders have no voting rights and virtually all bonds pay regular interest. Why not all stocks pay a dividend? Bond interest is guaranteed, while dividends are not.
Can you give an example to illustrate this difference for everybody to understand?
Of course. For example, suppose that you hold a bond issued by a company that has a coupon rate of 5% and you are scheduled to receive $50 in interest payment each year. As long as the company doesn't default on its obligation to pay the interest, you will receive that $50 each year until the bond matures. In contrast, if you hold a stock in the company that pays a dividend of $1 per share and you own 100 shares, you will receive $100 in dividend per year. However, if the company financial performance declines, the board of directors may decide to reduce or eliminate the dividend, and you may receive less income from investment.
As far as I found out, it's true that most of the stocks are traded on the stock exchange, while most of the bonds are free traded.
That's right. Unlike share of a company that trades on a stock exchange, most corporate bonds trade over the counter. OTC is an informal payment counter transaction. This is because bonds come from many different issuers, and each issuer will have a number of bonds on offer, with different maturities, coupons, nominal values, and credit ratings. Since they are not listed on major exchanges, investors have to look to their brokerage firms to arrange the buying and selling of bonds in many cases. The OTC market tends to be less regulated, less transparent, and less liquid than exchange trade security, increasing trading and counterparty risks. In the case of bankruptcy, bondholders have a higher claim on the company's assets and are more likely to get some to their money back.
Our program comes to the end. Many thanks to the two experts who spent time coming here today. Thank our audiences very much for listening attentively. We have prepared some questions for you. Please scan the QR code above. See you in the next programs.